And so thank you for bringing those up, because that's some things about these types of policies when we design them for that infinite banking system that people don't understand is when you're putting that money into those policies and it grows inside there, the dividends, the return of premium, the interest, that all grows tax-free.
Hi, this is Garrett Sutton, and you're listening to the Average Joe Finances Podcast.
If you're watching this on YouTube, make sure you smash the like and subscribe buttons. If you're listening to our podcast, go leave us a 5-star review. All of our links can be found in the video description or show notes below. Hey, welcome back to the Average Joe Finances Podcast. I'm your host, Mike Cavagioni, and today's guest is Dr. Rob Scranton. Rob, I am super excited to have you on the show. Thank you so much for joining me today.
Yeah, Mike, I'm excited to be on here as well, and it's nice to see it's sunny in Hawaii as it is here in Utah.
Yeah. We share the same sun.
That's right.
It goes around the entire planet.
the
it's
whole
just
world.
in a different position in the sky for you right now than it is for me. Like it just came up over here. But yeah, okay, right on. So I'm excited to talk to you today, especially with some of the things we're going to talk about, things that are not new to this podcast, which is really fun because I like talking about different financial strategies. And a lot of times when people are doing their search and trying to find information, it's always good to hear it from multiple sources and not just one person said, this person said that, and I'm just going to go do that because that person said, no, I heard this person, I heard Dr. Rob. And it just helps get somebody more educated before they make that decision. So I'm excited. I want to kick this off the same way I start every podcast episode. And we want to know more about you. So if you could share a little bit about yourself, share your story. Tell us, who is Dr. Rob Scranton?
Yeah, absolutely, Mike. And yeah, I appreciate that's really an interesting perspective. As you were saying that about hearing it from different voices, I don't think this concept that I'm going to spend some time talking about, so it would probably be the focus of our time here today. I probably was the third time I heard it before I really started doing it myself. The first time was like a smack in the face. Like, what? Like, no, that's I've never heard that before. That can't even be possible. And then the second time I heard it, I leaned to it a little bit more and listened a little closer. And I don't think it was even necessarily a totally different message. I was just finally had heard it enough times from, I need to really pay attention. This isn't one crazy person saying this. This is multiple people. And the last person I knew I really respected a lot. But yeah, an interesting journey to where I'm, at least my opinion anyways. I didn't know what I wanted to do when I went to school. So I applied to one school because I went to visit some older friends of mine that I'd been on the tennis team with at the University of Illinois and stayed in the dorm. And they took me to a fraternity party. And I'm like, man, that's what I want to do. I want to go to school there. Of course, your parents advise you like, yeah, that's a tough school, especially the business and engineering schools there. You might want to put in some other applications just in case to hedge your bets. I'm like, why would I put in other applications? That's where I want to go to school. Like, why wouldn't they not let me go there? Your 17-year-old brain. And that was not a very good parent lesson for them to teach me, because I got into the one school I applied to in the business school and I didn't know what I wanted to do. And my dad was like, oh, you could get a degree in accounting because the world will always need bean counters. And I'm like, all right, I'll do that. So I got a degree in accounting and finance. And I moved to Chicago, and in my dad's opinion, from our smaller town area, that was like where all the devils in the planet, he was sure all resided there. It wasn't the case, but I worked in all sorts of different areas in accounting and finance. I worked for a public accounting firm, so I prepared tax returns and did audits of companies. I remember one I had to audit. I thought it was really interesting because usually we all hear and know about depreciation, right? Where we went and we were auditing a company that did like waste management and owned dumps sites where they take the garbage. And so theirs was the opposite. Their land becomes unuseful when it's completely full instead of when it's depreciated or lost. And then I worked for a manufacturing company. And my last job, I was a financial analyst for the Florsheim Shoe Company. If any of your listeners are old enough to have heard of that company, they were a major retail men's dress shoe store that doesn't really exist too much anymore. And then I had an injury. I had a chiropractic experience that made me reassess what I was doing. And I got really passionate because this person helped me when nobody else really was able to help me. I went back to school and became a chiropractor. And I thought, oh, okay, well, I'm making pretty good money. But year after year, I just felt like I was just swimming in an endless sea. If you hear about the endless horizon, like I was making money, I was paying my bills, I was keeping the practice running. I just didn't feel like I was making any progress or going anywhere after about 10 years. It's just, oh my gosh, other people work for companies and they got pension plans or other off ramps like yourself in the Navy. I'm guessing you were there long enough that you probably got something or check on the end of that for a good portion of the rest of your life and so forth. But I had nothing like that. I came to the realization like, boy, the last patient I adjust is going to be the last paycheck that I ever get in my life from anywhere, unless Social Security is still there, which who knows. And so I started doing the traditional thing that most people do, is putting money away into 401k and IRA. But as I started doing that and putting money in there, it still didn't felt like I was making very quick or very good progress. And then 2008, 2009 came along and I was beginning my investing journey and packing it away. And like half of it was gone, like in 6, 7, 8 months. And then I also noticed how that could end up even at retirement age, as I watched my parents' friends, their accounts go down by 40%. And they were all in that just retiring stage. And most of my parents' friends were, oh, they talked like, I remember it very clearly because it was like this discussion. Oh, I would go into Lowe's or something. I would see them. I'm like, oh, hi, can you tell me where are the screws at? What I'm like, that's weird. I thought they retired. Why are they back here working? And then when you talk to them or they were over visiting my parents, were like, oh, I was just bored in retirement. I just need something to fill my time or whatever. And I'm like, yeah, I don't think that's true. They needed to go back to work. Oh, that would just suck. So I'm like, this isn't working for me. It didn't work for my parents or any of their friends, seemingly, or it hadn't worked for me so far. And it sucked. And I just didn't like that, watching the market go up and down. So I tried to trade myself and do options. And those things would work for a while. The problem is, being a doctor, is that even if things are going along well for a while, all of a sudden an employee quits and you're left shorthanded and you're scrambling. And a lot of these trading strategies and so forth required you to, even if it was like end of the day trading or something like that, it still required you to check it every day and be very diligent and on top of it and paying attention. And inevitably, there was always something going on in my actual business, my practice, that would unhinge my life, and I'd lose focus and lose track. And I'd come back like, oh yeah, I need to check my trading. And something had happened in the market or the options indicators that I should have made a move and I didn't, and I lost a bunch of money. And it just kept happening. So before, I think one of my biggest investment mistakes ever was putting all of my, I would say, I guess it was trust, but putting my finances in somebody else's hands and letting them control it. That was the market, the 401ks, the professional money handlers, and boom, dropped by half. But then trying to do it myself, found I just didn't have the capacity because most of the strategies took such diligence and you had to be on top of it, because it could work if you could do that. But life happens and goes on, and would constantly seem to short circuit all that stuff. So I heard this guy talking about this thing called the infinite banking concept. And I was like, wow, that just sounds absolutely phenomenal. So I went to my financial professional, and man, he just shut that down, backslapped me for even bringing it up or talking about it. I'm like,
that's
wow.
not a traditional way of doing things. So of course that's not something they're going to be interested in exploring with you.
I didn't understand all of that, and I didn't understand their motivation behind their suggestions, what they're saying. I was still, I think, very naive, really, at that point. And then I was talking to my dad about it because I just thought, man, this just seems so amazing. But obviously, that was not well received by my financial professional. So I talked to my dad about it, and he says, "Oh, he says that does sound really interesting." He says, "We've got a family history with that," and he talked about my great grandfather during the Depression. Of course, what farmers used to do is every spring they would go to the seed company and they would get their seed on on loan or on credit to plant, and then harvest in the fall, sell the crop, and then pay back the seed company. During the Depression, the bank in his town went completely bankrupt, and the seed company didn't trust anybody because everybody was going bankrupt, and they didn't want to loan or give anything out on credit to anybody. So it's like, where am I going to come up with the money to plant my crop? I'm not going to be able to pay for the farmhouse and the land and so forth. And but he did remember that he had this very old whole life insurance contract that had cash value accumulated inside it. So he contacted the company, and they asked him how much he needed for the seed, and so they were able to wire the money to him, and he was able to buy the seed, plant the crop, harvest it, sold it, and then paid back the money to his whole life insurance policy that he had borrowed, and filled that reservoir, if you will, back up again, and was able to survive the Depression and do just fine, because that's one of the things people still needed was food, even during the Depression. So without, that's the story that's been handed down. I've heard my dad tell that many times to people, that this
So
concept.
you've had your own infinite banking story in your own family before you even knew about it.
Yeah, and
That's
didn't know that
yeah,
there was a story about it. Yeah,
that's pretty
exactly.
neat.
And my dad was like, and I don't think my dad really thought of that as an infinite banking story, because this wasn't really designed, this great grandfather of mine's policy wasn't designed as well as we can design a policy specifically for the infinite banking system. His was just a typical run-of-the-mill whole life insurance policy, but they worked so well after, especially over time, that he had those cash reserves in there. And so then my dad was telling me that story, and then he brought it. He says, "I should show you something." So he went back to his office and pulled out from one of his files and brought me. He had bought, because again, this family story that I wasn't, maybe I wasn't old enough to be privy to it yet. Everybody in my family, that's where they had stuffed money, buying whole life insurance contracts. And I didn't know that either. So my
Hmm.
dad brought out this one. Here's one that I bought on you when you were 1 years old. It was he says, and you're probably old enough now, then you're interested in this anyways. It's probably time that you take over the payments for this, and I'll just make you the owner of the policy, and you can be in charge of taking care of it and so forth. So it's a $50 a year premium policy with $10,000 death benefit. In 1970, that covered a lot of stuff. I don't know.
Yeah, yeah.
But what was interesting is that's where I really, because I was already learning about this infinite banking concept, and I was able to look at my own policy and see this is not just theory, and this wasn't just a story about my great grandfather. Now this is real, because this is my own policy that I didn't even know that my dad had on me, that he's showing me. And so this $50 a year premium deposit was purchasing $350 a year in cash growth. Now, those aren't big numbers, but if you do the math of, that's a 700% return year over year on the money that is deposited into that automatically. It's guaranteed because it's in a contract with a life insurance company. And so I took this to my financial professional, and I don't know what I was thinking. I must have been suffering from severe mental trauma or some kind of brain aneurysm or something, but he convinced me to stop paying that and put that into some hot stock or something he had, to pull all my cash, to surrender the policy, basically to take all the cash off, stop the policy. And I think back on it now, and that has got to be some kind of malpractice for a financial professional to take anything that somebody is putting $50 a year in, that's automatically immediately generating $350 a year. Yes, it's a small amount. So that's why so I'm okay telling the story. It's not as painful. I just think, though, if there had been 2 or 3 extra zeros on that, it'd have been $5,500 or $5,000 a year. And and $350,000 growth every year, I would probably be pretty upset and mad about that. And so my dad had a policy, still got in place, that his dad put on him in 1951. And that policy that is now the death benefit is 8 times the original face amount. And that policy annually grows and increases in cash value by 1,300% a year, guaranteed. Now, when you're in your 70s and 80s, would you like to have some places that you could stuff money into that would return automatically 1,300% guaranteed every single year, and it never goes down? And you don't have to have the sick feeling in your stomach of it bouncing up and down and wondering where it's at today and being on a high tomorrow and then depressed 2 days after that. And like I said, the third time I heard about this, I jumped into this and did this myself. And I was so excited
Well,
about it.
hey,
And
can I jump in real quick, Rob?
yeah,
Because I'm curious, like, how did they have such a high return on those policies? Because even when I like look at whole life insurance policies now, they are not returning that much. That's crazy. Like, how did they have is it because the contract was done back in the 70s and it's just that's what it was and it just
yes,
stuck with it the whole time?
yeah, certainly. My oldest policy right now is, not near as good as that. It's about 14 years old,
Mhm.
and it right now, and the money I put into it, it returns about 179% per year. But last year it was
Even that's
170.
extremely good.
Yeah, exactly. It's not 700%, it's not 1,300%. But again, where else am I going to stick $10,000 this year and immediately somebody's going to, Mike, just think about it. So if I gave you $10,000 and you immediately gave me $17,000 back right away, how often would you want to do that? If that was a
I'd
gambling
want to do that all
table.
the time, but then I'd also be like, okay, how does this work?
What's interesting is the type of policies that we do with this are unique. We only do them with mutual insurance companies.
Mm,
So they're not risky. They're not publicly traded. As a policy holder with a company like that, you actually are one of the owners of the company. So you really get paid in 3 different ways. So you have the guaranteed interest rate. You have, as a policy holder also being a owner of the company. When the company does well and profits, you receive dividends, shares of the profit in the company. And then there's also what's called a return of premium. So if fewer people die than are expected in a certain year, then that allotment of that extra that's been paid is also shared with the policyholder owners. And over time, but that's exciting and that's cool, but that's not even one of the most amazing aspects about having these policies. Now that I've got 7 policies between myself, my wife, my kids, and to me, the most amazing thing about it is every time I've ever done anything, taken money out because I was trying to outbid somebody to buy a cabin up in northern Utah. It's up at about 8,000 feet, and we had to move fast. So where could I pull money from quickly? I called hundreds and hundreds of thousands of dollars in cash value in my life insurance policy. I was able to get that money in 2 days. And the nice thing
nice.
about that, while I was using that to do that to secure the property until I could get more normal traditional financing for it, because I had to move fast because all these people from California escaping, moving to Utah. But what's really interesting, Mike, is the whole time that I had that money in that policy and I took it and I used it to purchase this house, the money never left my policy. So I never stopped the compounding and growth inside that policy, even while I was using it somewhere else to do something different. And I've done this with somebody who's willing to pay you, say they've got a business. I'm just thinking of one that I know of off the top of my head, a guy that buys when somebody's business forecloses and he can buy at auction like a whole bunch of forklifts and he'll
Yeah.
buy them, but they're like $25,000 a piece. And he wants to buy as many as he can because he can bring them into his shop, sandblast them, spray paint them, put new tires on them, get the hydraulics working properly again. And he can turn around and sell it for $30,000 in 30 days. But if he wants to buy 40 forklifts at a time, he might not have that cash sitting around, but he's
Yeah.
willing to
And somebody
take
might
other.
not lend that to you either. So
But a hard money loan, he's willing to pay 6% to have that money to secure those vehicles so he can turn around and flip them a month later. It's stuff like that you can do and earn interest there while you're still earning it inside the policy. I just
Yeah,
don't
yeah,
know of any
you're
other.
double dipping at that point. I know other people
Absolutely.
that do infinite banking, right? And they'll pull money out to put a down payment on a piece of real estate, right?
That's very
And
common.
rental property, and now they're getting a return on that rental property while still getting a return on the down payment that they took out. So it's essentially double dipping. And then the other
Yep.
beautiful part about it too is the interest that you pay on it is going back into your policy. So as you're
Yep.
paying the interest on this loan, it's going right back into your life insurance policy, which is awesome. So that's one of the things that I really like about it. But I wanted to ask you too, Rob, what kind of tax benefits have you seen from using the infinite banking concept, right? Because a lot of times if you go buy real estate, whatever it is that you do, there's always tax implications, right? With whatever it is, whenever you make a profit on something, you got to pay taxes. How does that work when you're making money through infinite banking, like with the interest that you're getting, with the compound interest that you're getting on your policies? How is that taxed?
That's there's some really unique things about whole life insurance policies. And some of the reasons they're unique is because all the companies that we work with have been in business for well over 100 years, on average 47 years, as far back as 1847. And so these companies and these products predate the income tax system and the IRS itself. So they didn't really have a way to screw these things up or steal the money through taxes, like what I think you're trying to indicate. And that's some of the things we tell people when they ask me, Rob, what do you do? I basically teach people how to use the debts and expenses they already have to grow their wealth. And one of my main goals in life, and what I get excited telling other people about, is really my goal is to get as much of my money as I possibly can in a tax-free environment and get the government the heck out of my hair as much as I can. And so thank you for bringing those up, because that's some things about these types of policies when we design them for that infinite banking system that people don't understand is when you're putting that money into those policies and it grows inside there, the dividends, the return of premium, the interest, that all grows tax-free. And then everything that you put in there, you can withdraw tax-free. And when you get past that point, even there's more cash value in that. You can take loans against the policy up to the full amount of the cash value inside there. And the government does not consider loans to be income. And a lot of people are even using this, myself included, as part of their retirement plan. Because think of somebody taking in a 401k plan. They used to say, don't ever draw down more than 4% a year. And I remember my parents' friends, they're just like, man, I just feel so devastated, because I always thought my whole working career that if you could save $1 million and have it in some kind of a IRA or 401k, that you'd be set. You'd be fine. But even that, I think about that. I'm like, if you're only allowed to take 4% out, that's only $40,000 a year. That's not going to, get you very far. But they've revised that. You've probably seen that in recent years. They're saying you really didn't avoid running out of money because people are living so much longer. You really shouldn't take out more than 1.9% per year.
Yeah, I've
Is the
heard
number I've heard.
2% a lot. Yeah, that's
I'm
that's
like, that's
wild.
like
And off
bucks
of
a
that,
year.
you need to have $3-4 million in there to
Yeah.
have some type of possible living wage if that's what you're withdrawing. So yeah, that's where it gets a little risky and crazy, like for me. And that's why, like for me, I've always preferred real estate. Like I do have money in other accounts and everything, but real estate I always felt was the most tangible thing. I like alternative investments in general.
Yeah.
Even through this infinite banking concept, which is also great because you can, for real estate investors, you can utilize that to buy more real estate to increase your cash flow, all while still letting that grow, that policy grow. And you could use it in the future as well. After you pay off that down payment, go use it on something else. And even if you didn't take out the entire amount, you can still take out more money. And that's the crazy thing about it, is how you could borrow up to 100%, where I've borrowed from, so in the Navy, I had this thing called the thrift savings plan. I borrowed from that to buy a piece of real estate, right? I was only allowed to take out up to 50%. I think it was 50% to take out on that loan of the value of what was in there. And that's because volatility, if the market goes down, they don't want you to lose all your money. And the thing is, the money that I borrowed, that I took out, that's no longer gaining interest. That money's not there anymore. It is now with me. Now, of course, when I paid it back and the interest I was paying back went into my account, so I wasn't like paying a bank or anything, but I was also missing out on 50% of my interest that I could have been making the entire time. Where if I had
Opportunity
pulled that out
cost.
from a life insurance policy, it would continue growing even while I had that money out. And that's one
Absolutely.
of the things that I'm a really big fan of when it comes to infinite banking. I think that's fantastic.
That's that example you're using is one of the examples we have on our website, teaching people how to buy all their cars that they're ever going to buy,
Ooh, look at
drive,
that.
and own the rest of
Boom.
their life, and get all the money back the rest of their life, right?
I'll give you that clip and you can throw that up on your website. You
Go.
know, hey,
Okay.
look at okay, Rob, I want to ask you though, like when it comes to somebody that wants to get started and get a policy, a lot of times I know you have to like front load it to make this where it's going to work. So if somebody wanted to start, like what kind of numbers are they looking at? Like they wanted to start a policy and get themselves to a point where the premium already has, I mean, like it already has a cash value. What kind of money are they looking to bring to the table for that?
Well, the insurance company will only allow you to insure yourself up to us. They won't let you, they'll never let you over insure yourself. And so usually if you're in your 30s, they may allow you to insure yourself up to 25 times your annual income. If you're in your
Hmm.
50s, it starts to get more like maybe 10 times. So that's going to be a limitation. It's an interesting concept is the number of times I've talked to people about they come to me with kind of the assumption that I can just go get a life insurance policy when that's really not the relationship. It is a unilateral contract in the fact that once you have a policy in place, the insurance company can never cancel it on you, but you can cancel it on them at any time. That's one of the few unilateral contracts that it exists in the universe, but there is a price for that, that in the beginning, they're going to vet you and make sure that you are somebody that they feel is worth the risk for them to invest in. So you can request anything, but the insurance company is ultimately going to tell you what they'll allow you. And I think the other thing that you're asking about that is is there some minimal amount to get started doing that?
Yeah.
Because like my kids, their first policies I took them out were about $3,000 per year. So not very big policies. I mean, broke it up. That's a couple $100 a month on a kid, but because of them starting so early, my son that eventually that policy will cost him about $1,300 a month when he's 50 years old. But the cash growth year over year, I just started working on that policy yesterday for him, is going to be returning $20,000 per year every year for that $1,300 deposit. So not as good as, like we said, those ones of my dad or mine that were 700, 1,300%. But again, that's pretty darn
Yeah.
good.
When you're talking about the returns, you're talking about like when you actually start withdrawing from it, right? And the cash value and right. Is that what you're talking
So
about? Like in the end, like that's what you're looking at?
So what I'm talking about is an illustration from the insurance company showing this is how much when you're putting in this each year that this cash growth is going to happen every single year.
Okay. Right on.
I think one of the things you're asking before about the tax implications and
Hmm.
the tax deferred growth is one of the things I think is really neat is that we can really create economic certainty. If somebody wanted to guarantee that when I retire, I'll have something that at 65 years old that I can pull $100,000 out a year and it will be there for the next 20 years. And what's neat is we can actually backward engineer and figure out what their age is and what they would have to contribute today, because it's just math. So that guarantee that they will have that 100,000 to pull out tax free in retirement if they wanted to be able to plan that way. And most of what's called is called retirement planning, in my opinion, is like that Monte Carlo casino game. They're using uncertain variables in the present to predict something that's going to happen in the future. And that just inherently is completely illogical that you could ever do that.
Yeah. When it comes to investing, I hate the G word, guaranteed, but when it comes to life insurance policies, you actually sign a contract with what these returns are going to be and what you're getting. So it's a little bit different. And it's one of the few things that you can like really be rest assured that this is what you're going to get because
Mhm.
you are signing a contract with that insurance company. Now, I wanted to ask you, so let's say I took out whole bunch of loans, right? Because I
Mhm.
used it for whatever, and then something tragic happened and I died.
Mhm.
What happens now to those loans and then to my death benefit on those policies?
So try to use real easy round numbers. So say at that point when you died, that the total death benefit, including the death benefit and the cash value, would have been $1 million.
Mhm.
You had taken out $200,000 in loans. You plan to pay them back to yourself as a good, honest banker would,
Mhm.
but something happened and threw your plan off and you died before you paid them back. So you had the $1 million in total death benefit, including the cash value and the death benefit of the policy, but you'd taken $200,000 out. You hadn't repaid those by the time that you died. So the only thing that would happen was be your beneficiary at the time of your death. Instead of receiving $1 million, they would receive $800,000.
Okay. Yeah, makes perfect sense. So there is no, you're not really risking the money, right? Because you used it for the purpose that you used it for, and it's already been withdrawn just early at that point.
Right.
So it's
Well,
not it's not if you had an outstanding loan that the insurance company can come back and say, "Oh, you had a $200,000 loan, your death benefit's $1 million, but because the loan wasn't paid, we're not going to pay you." So
yeah, it would
that's
cancel
good
the
to know.
policy or something
Right,
like
right.
that. Some people can have that,
I feel like a lot of people would
kind of
that's one of the things they
misconception.
would fear, right? Is
Mhm.
okay, if I am doing this concept and I am borrowing from it, and then God forbid something happens, now did I just risk my family? Did I just risk the money that they would get from the policy? So that's why I wanted to bring that up, because I feel like if you don't talk about certain things, people just think in the back of their head. And when they start thinking in the back of their head of the what ifs without having the definitive answer, it starts to throw you off and say, maybe this isn't for me because I just don't have enough information. That's why I'm trying to pick all the little pieces out that I can to extract as much information from you as possible here.
One of the
So,
fun games, I don't know if you've ever heard this put this way before that I talk to people about. There's not too many people that have you ever thought about being able to spend down every dollar you've ever earned your entire life before you die? That's probably pretty rare, right? Because the traditional way of doing finances, like we talked about, is that most people set aside this huge pile of money, $1 million, $2 million, are trying to live off the interest, and then they die. And that $2 million, they never got to enjoy their entire life. They never got to spend it. They never got to buy those nicer shoes or take that extra vacation or anything. With this concept, and if we were to try to do the same thing and live off the cash value in retirement, doing it this way, we could potentially spend down every single dollar that we've ever made. Say that same $2 million. I'm just going to use an example that is not real numbers. At that same $2 million, and we put that into whole life insurance contract. And so say now there's $4 million total death benefit, 2 million of that was cash value. We spent that down over 20 years at 100,000 a year. We literally spent the policy down to nothing. But one of two things happened, and we either have died somewhere in between there, or we lived beyond that 20 years. And so we literally spent every dollar we'd ever made, enjoyed every dollar we ever made. And if we died exactly at 20 years, we would still be able to leave everything to our children and family. There'd be another $2 million for them. Versus if you leave that 401k, the government's going to take a bunch of it and you never got to enjoy it for your entire life. So it's
yeah.
an interesting way to look at that and play with that as well. And even if you die, even if you didn't die, that something tragic happened, you continue to leave, you could even sell that policy on a secondary market called a viatical market, where you'll find people every day willing to give you $1 million for a $2 million death benefit policy when you're 85 years old, because they feel pretty confident somewhere in the next 5 or 10 years that they'll be able to double their money guaranteed. And I know you didn't like the word guaranteed, but in this case, it is actually guaranteed, not just a
Yeah.
sales technique for an investment
So
strategy.
I didn't know you could do that. You could actually sell your policy on yourself to someone else so that when, well, I
You'd have
guess I
another
guess you're
$1 million
changing them
to
to
live
be the
off of, right?
beneficiary, right? Is that what
Yep,
it is? Like they pay you
exactly.
to be your
Yep.
beneficiary.
Yep,
Oh, wow.
you change the beneficiary on the policy, and you can sell that on a secondary market. So even if you got to the end of your life and you're like, oh my gosh, imagine if your 401k account was depleting down to nothing. What else would there be? There's still another little juicy bit on the end of it. It'd be nice, either you're going to die and your kids are going to get all the money, or if something terrible happen, you continue to live, there's this other option to that as well. And again, all that money that you take out as loans, you're never taxed on it. So you could be living off $100,000 you're taking out in loans and using that to fund your lifestyle, where somebody else might have to pull $140,000 out of their 401k, and after they pay taxes, end up with that $100,000.
Sure.
And
Yeah.
plus, they're going to have $100,000 income, and then the IRS is going to come in and say, you don't deserve as much as your Social Security check because you make too much income. Whereas if we're pulling the money out and living off, paying our living expenses off our loans and our policy, we look like we're destitute and broke because it's a loan and the IRS doesn't count that as income. So we
Right.
get our entire full Social Security benefit as well.
Yeah, no, that's a great point. That's a great point. All right, Rob, now I'd like to transition this into something that I
Mhm.
call the final round. It's where I'm going to
Okay.
ask you the same 4 questions I ask everybody that comes on the show. And it gives us a good idea of how you are when you're under a little bit of pressure, which I'm sure you're going to be fine because you get a lot of pressure when you're working on all these policies. So if you're ready to go, we'll get that party started.
Absolutely.
All right, here we go. So Dr. Rob Scranton, the very first question of the final round for you is, what's the biggest mistake you've ever made when it comes to your own finances or business life?
I would have to say the first time I heard about that, I told you before, Mike, probably the third time I heard about this concept before I actually took action and did something about it. And that's the same thing. That's what I love working in this industry and helping people do this, because that's the only regret I ever have that I hear from people. And it's the same regret I have, is that I didn't start sooner and I didn't start with a bigger amount when I did start.
Fair enough. Fair enough. Yeah. I feel like that's a very that's something that a lot of people can identify with. I
Mhm.
believe when it comes to just anything in life, when it comes to, I wish I would have done this sooner. I wish I didn't wait until the third time I heard about it. So I appreciate that.
Yep.
Okay. Next question. You're going to see that these all kind of tie into each other, Rob, is what is something that you've learned that you wish you knew when you first started out?
I had the benefit of having an accounting and finance degree. And when I started looking at this infinite banking concept, I dissected it every which way possible. And I couldn't poke any holes in it. But I still kept thinking to myself, because most of us grew up hearing that, right? If it sounds too good to be true, and it did sound too good to be true, but I think that's something that I had to wake up to, that not everything that seems too good to be true, sometimes things that sound too good to be true actually are true.
Yeah, and it is difficult because there are a lot of products out there that seem too good to be true that really are, right?
Like,
It's all about, it's how things are structured, right? Not everybody can go get a whole life insurance policy and have it be something that they can use as a product for infinite banking, right? So it has to be
mhm.
structured properly. You need to use the right people, get the right professionals involved, and that's what makes the difference. So with you having the education that you had, you were able to poke those holes and figure out, okay, like it does seem too good to be true, but if you do it this way, it actually works. Yeah,
That's
yeah,
right.
definitely appreciate that. Okay, next question. Do you have any tips or tricks that you would recommend to someone that is just getting started today? Let's say somebody says, okay, I want to start my whole life insurance policy so I can start infinite banking. What would you say to somebody like that?
I would bet you would probably give somebody the same advice in real estate, Mike. Just because they can't go out and buy a 110 unit complex with their first deal doesn't mean that they shouldn't start investing in real estate. Buy a duplex, buy a single family home or something like that. Start where you're at until you start to learn the ropes and you really see how this works and you gain experience and knowledge. And then, like I was, like about every year and a half, I keep buying more policies, because every year, that I told you about that before, instead of growing 172% a year, this year it grew 179%. Next year it's on track to grow 183%. So I just want to get more and more policies, as many as I possibly can, doing that for me. So I tell people that, hey, start where you're at, and so that you can eventually get to where you want to be.
Yeah, absolutely.
Don't
You
let
have
it
to start
intimidate
somewhere.
you. That's
Yeah,
right. Yeah.
you have to start somewhere. If you can't come into a policy and just dump 100 grand into it, that's okay,
Yeah.
right? Open the policy, get started paying the premiums, and get a good idea for how it works. So,
And
yeah,
my first policy was $200 a month because I really liked the idea. I was totally sold on it, but I'm still nervous and anxious about it too.
nice, nice. I think, how much am I paying a month on mine? Like a couple hundred a month on each policy. Yeah, for me and my wife. So I have a
And
policy on
I'm
both
over
of us,
50
but
or $60,000 a year that I put into my banking
nice.
system. So I've certainly grown from there.
Awesome. Yeah. All right. Okay. Final question of the final round, and this is just opinion based, but do you have a favorite business, investing, or real estate related book or podcast or both?
Yeah, though, if some people want to know more about this, I would say there's a book called Becoming Your Own Banker by R. Nelson Nash. It's a Bible of this subject. And a lot of people have, since he wrote that, come up with different variations and different twists on this. But it's one of those things where the original writings and ideas, I think people end up circling back and going back to as well. So might as well just start there. And we really very closely adhere to what he originally taught in that book. And it's been phenomenal for us and my family and the things we've done and for our clients as well. So I
Yeah,
highly
that's
recommend that.
awesome.
I probably
Yeah,
still reread that book
I've
once a
heard that
year.
book recommendation before, so it's on my list. I've not read it yet, but
You have
that
to
is on
put it
my
in your
list, and
library now,
I
huh?
think it's moving up. So
Well, I have it on audio as well if you're more consume stuff that way as well.
I'm a big consumer of audio and video content. So maybe I should start listening to more audiobooks and less podcasts, but I love listening to podcasts. Okay.
That makes sense.
Yeah, it does. It does. All right. Dr. Rob, this has been absolutely phenomenal. I feel like we had a great conversation, learned a lot of information. I, I know I jumped in a couple times, but I like extracting as much information as I can to make sure that my listeners are getting a good understanding of what it is that you do and with when it comes to infinite banking. So with that being said, so the final round is over, but I do have another question I want to ask you, and that's going to be for my listeners here is where can people find more information about you? Do you have a website you could share with us or any social
Yeah.
media, anything like that?
Absolutely. So they can go to and I would recommend that if they found this subject interesting, and obviously you have some knowledge about this. Some of you had asked very good questions and had some good insight to add in there to make sure we covered some things. But my website is called yourfinancialiq.org. So yourfinancialiq.org. And we have a free masterclass on there where we go through and show an illustration of how if somebody paying all their loans back over $475,000, that if they were continued on their path to pay those down would have taken them 19 years. And we show how they did it in just less than 5 years, just by changing one thing in their financial life and cycling all their money through their banking system instead of just paying those loans one at a time as they had traditionally been. And we'll also show everybody that wants to learn how to do that, how to buy all the cars that they're ever going to buy, drive, and own the rest of their life and get all the money back for all the cars that they buy, drive, and own the rest of their life and have the car at the same time. So we have that masterclass available for anybody that wants it that they can watch on there as well.
Awesome. And you also mentioned that it's free, which is my favorite price. I just want to point that
Yes,
out.
absolutely.
Hey, we'll make sure we have that in the show notes to make it easy for people to copy and paste or click away. Only thing I ask to my listeners is if you're driving right now, please don't do it while you're driving. Thank you very much. Hey, so Dr. Rob, this has been absolutely a blast. A lot of great information, a lot of golden nuggets. I really appreciate you taking the time to chat with me and share your story with our audience today. It's greatly appreciated. So again, thank you so much for joining me.
Thanks for having me on, Mike, and allowing us to continue to spread this message of financial freedom for families out there.
Absolutely. That's what it's all about is financial independence. That's what we're all about. I also want to thank all of you, my listeners, for joining me and our special guest, Dr. Rob Scranton, on the Average Joe Finances podcast. Go leave us a 5-star review and tell us what you liked about today's episode with Dr. Rob. Aloha from Hawaii and have a great rest of your day. Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.